Are you paying tax on your savings? If so, this video will save you money. In the UK, there is a way to keep your savings completely tax-free. It's called an ISA. In this video, I will show you what an ISA really is, how it works in real life, and 6 practical tips to use it properly, so you stop paying tax you don't need to. Let's begin. Hi, I'm Cici, an FCCA qualified accountant. After years of working in UK accounting firms, my goal now is simple: to strip away the jargon and help you actually master your money, tax, and investing. First, let me ask you something. Imagine there is a special box. Every pound you put inside this box grows, completely untouched by tax. No tax on interest, no tax on dividends, no tax on investment profits. Sounds unreal, right? Well, that box exists. It's called an ISA, Individual Savings Account. But here is the part most beginners get wrong. An ISA is not an investment, it's a wrapper, a protective shield. You can put things inside the wrapper: cash, shares, funds, ETFs, and bonds. But once they're inside, the taxman is legally locked out. Your normal bank account is like a public locker. The taxman has a spare key. But your ISA, that's your private VIP safe. No one can take anything from it. Every adult in the UK gets a fresh £20,000 total ISA allowance every year. It resets every 6th April and ends every 5th April. If you are married or in a civil partnership, congratulations, your household potential is £40,000. Now that the basics are clear, let's break down the 5 ISA types so you know exactly which ones matter for you. Let's start with the simplest ISA, the cash ISA. It's simply a savings account where all interest is tax-free. I want to play a quick game with you. Imagine you have £30,000 to save. You've got 2 options. Option A, a normal savings account offering a 4.5% gross interest rate. Option B, a cash ISA with a guaranteed tax-free rate of 4%. Now, which one would you pick? You may shout, it's obviously 4.5%. Higher rate means more money. But let's quickly run the numbers. If you are a basic rate taxpayer, here is how it plays out. Option A, at 4.5%, you earn £1,350 in interest. Looks great on paper, right? But then HMRC steps in. They take the 20% cut. That is £270 gone, vanished. You are left with £1,080. Now look at option B. At 4%, you earn £1,200. Taxman tax 0. You keep £1,200. So even with the lower interest rate, the cash ISA still leaves you with £120 more. And if you are a higher rate taxpayer at 40%, it's even worse. That same £1,350 interest drops to just £810 after tax, while the cash ISA still gives you £1,200 tax-free. So don't let the shiny interest rate fool you. In this case, the cash ISA leaves you with more money in your pocket. Surprising, right? Sometimes the smart money move isn't the one that looks best on paper, it's the one that beats the taxman. Now, some of you might be thinking, but wait, I have a personal savings allowance. I can earn interest tax-free, right? And you're right. The personal savings allowance, or PSA for short, lets you earn a certain amount of savings interest tax-free, depending on your income. If you are a basic rate taxpayer, you can earn £1,000 interest without paying tax. If you are a higher rate taxpayer, that drops to just £500. And if you are additional rate taxpayer, unlucky, you get no allowance at all. But here is the problem. Interest rates are much higher than they were a few years ago, which means your PSA gets used up very quickly. A basic rate taxpayer only needs £23,000 at 4.5% interest to completely use up the PSA. A higher rate taxpayer, just the £12,000 of savings and your allowance is gone. So what happens next? Every bit of interest above your allowance gets taxed at 20%, 40%, or even 45%. That's why cash ISAs are such a powerful tool right now. Whether you are saving for an emergency fund or planning short-term goals, using a cash ISA can legally shield your savings from tax. The cash ISA comes in three main types. First, easy access. Think of this as your panic button fund, perfect for emergencies. Second, fixed rate. This is for locking it away. If you know you won't touch the money for a year or two, you get a better rate. Third, the regular saver. This is for the habit builder. You drip feed money every month. Great if you don't have a lump sum yet, but want to build discipline. But before we move on, there is something hugely important you need to know. Starting 6 April 2027, the government is changing the rules of the game. Here is the simple version of what's happening. First, if you are under 65 years old, you can only put £12,000 per year into a cash ISA. Your overall £20,000 ISA allowance stays the same, but the remaining £8,000 must go into other ISA types. However, if you are 65 or older, nothing changes. You keep your full £20,000 cash allowance. So, why are they doing this? What is the hidden message here? It's actually very clear. The system is telling us that cash ISAs are a safety tool, not a wealth tool. They are perfect for your emergency fund. But if you are trying to build a real freedom, if you are trying to retire early, you literally cannot afford to keep all your money in cash anymore. You need a different vehicle. You need the engine that powers real wealth. Which brings us to the one thing I wish I had studied in my 20s. A stock and shares ISA. If the cash ISA is your safety net, the stocks and shares ISA is your wealth machine. Inside this ISA, you can invest in funds, ETFs, companies, and bonds. And the best part, all your profits and dividends are completely tax-free, forever. Now you might be thinking, I don't have much to invest. Tax isn't my problem yet. So, before I explain why this matters so much, let's play a quick quiz. If you invest just £100 a month for 30 years, earning about 10% a year, how much do you think you'd end up with? Choose one. A. £36,000. B. £60,000. C. £100,000. D. Over £200,000. Got your answer? Lock it in your head. The real answer is D. Over £200,000. Yes, from just £100 a month. Here is the key point. That huge jump didn't come from your salary. It came from compounding. And compounding grows fastest when your returns aren't being taxed. Outside an ISA, the government taxes a slice of your success. On dividends, they take a slice. Sell for profit, they take another slice. It's like climbing a mountain while you're carrying a backpack full of bricks. The higher you go, the heavier it gets. But inside a stock and shares ISA, zero tax. Every penny of your profits and dividends stays with you. Same mountain, but no backpack. You might be wondering, is 10% a year for that long even realistic? Let's look at a real-world example, the S&P 500 index fund. Historically, since the 1950s, the S&P 500 has returned around 10% per year on average. Assume you put £100 a month into the S&P 500 index fund for 30 years, starting from year 1996. Total you put in £36,000. Potential value over £200,000. And here is the magic number, growth from the market alone, over £190,000. You didn't work extra hours, you simply invested consistently. and let time and compounding do the heavy lifting. But here is the painful bit. If you wanted to cash out that £190,000 of profit, you would potentially be looking at paying thousands, tens of thousands in capital gains tax. Money that could have paid for your child's university or your early retirement. Inside the stocks and shares ISA, every penny of that £190,000 gross stays yours. Zero tax. That is why this account isn't just a nice to have, it is life-changing. When you are ready to start, choosing a low-fee platform really matters. Personally, I use Vanguard and trade in 2 and 2. Simple, low-cost, ideal for beginners focused on long-term investing. Because in the long run, true wealth building is simple. Avoid high fees, avoid tax, and let compounding work its magic. This next ISA is wild. The government literally gives you free money, but only if you avoid one painful trap most people don't know about. The lifetime ISA, or LISA, is designed for just 2 things: buying your first home or saving for retirement. Sounds simple, but here is where it gets exciting. The government gives you a 25% bonus on everything you contribute. Put in £4,000 a year, you get the instant £1,000 for free. That's guaranteed money, zero investing skills needed. But here is the catch that many people miss. This bonus only works if you use the LISA for the right purpose. Use it for anything else, and the penalty hits harder than losing the bonus. Let me show you how the math actually works. You deposit £4,000, government adds £1,000, so total £5,000. But if you withdraw for the wrong reason, the penalty is 25% of the whole £5,000, which is £1,250. So you only get £3,750 back. You didn't just lose the bonus, you lost £250 of your own money. So the rule is simple. Never put money into a LISA unless you are absolutely sure you will use it for first home or for retirement after age 60. If not, the penalty will hurt. The next one is Innovative Finance ISA, or IFISA for short. We will keep this one short because honestly, this is not part of your core wealth building strategy. The IFISA lets you lend money to people or businesses through peer-to-peer platforms. In return, you earn interest. It sounds attractive because the interest rate can be high. But here is the problem. Borrowers can default. You could lose some or all of your money. Because of this, personally, I'm not a fan of IFISAs. The risk is simply too high for most people, especially beginners. Now for the final ISA, one that can transform your child's financial future, the Junior ISA or JISA is a tax-free savings or investment account for children under 18. It's managed by parents, but fully belongs to the child once they turn 18. The JISA allowance is £9,000 per child per tax year, completely separate from your own £20,000 ISA allowance. So, if you have 2 kids, that's £18,000 of extra tax-free space each year. There are 2 types, Cash Junior ISA and Stock and Shares Junior ISA. Because children have a long time horizon, the Stocks and Shares JISA is usually the best long-term growth vehicle. When your child turns 18, their JISA automatically turns into a full adult ISA. No tax, no transfers, no selling investments, just a pure continuous compounding. But here is the honest warning every parent needs to hear. At 18, the entire pot legally belongs to your child. They can withdraw all of it. Whether they want to pay for university or spend it on video games is up to them. So start money conversations early. Teach them how to use it wisely. So those are the 5 types of ISAs and the basic rules behind each one. Now, let's talk about how to use them together and avoid the most common mistakes that cost people unnecessary tax. Here are 6 practical tips to help you use ISAs properly. Tip number 1, the SMART order. In simple terms, this means don't just throw money into random accounts. Build a pyramid. Base layer, Cash ISA. This is strictly for your emergency fund. Middle layer. Stocks and shares ISA. This is for your main wealth engine for growth. Top layer. Lifetime ISA, a bonus for your first home or retirement. And remember the 2027 rule. Reliance on cash is become harder, so fill the emergency bucket first, then push everything else into growth. Tip number 2. The £20,000 allowance is total, not per ISA. This is one of the biggest beginner mistakes. Your £20,000 annual allowance is shared across all your adult ISAs, not a per account limit. If you put £10,000 in cash, £5,000 in stocks, and £4,000 in a lifetime ISA, you have used £90,000. You only have £1,000 left across everything. The only separate allowance is the junior ISA's £9,000 per child. Everything else, it comes out of your one big pie. And remember, from April 2027, under 65s can only put up to £12,000 of that allowance into a cash ISA. The rest must go into other ISA types. Tip number 3, the sponsor shield. If you are married or in a civil partnership, play as a team. You each get the £20,000 allowance. That means together you can shield £40,000 of wealth from the taxman every single year. Don't let one partner's allowance go to waste while the other pays tax. Balance it out. Tip number 4. Use it or lose it. Your ISA allowance resets every 6 April. If you don't use it, it disappears forever. No rollover, no carry forward. Even if you can only put in £50 right now, do it. Lock in that tax-free status before the allowance is wasted. Tip number 5. Transfer old ISAs properly. You can transfer previous year's ISAs to a new provider without using up your current allowance. This means you can move old cash ISAs to stock and shares, switch to lower fee platforms, upgrade to better interest rates. Just remember, always ask your new provider for official transfer. Let them move the money directly. Don't withdraw the money yourself, or you will lose tax-free space. Tip number 6. Understand flexible ISAs. Finally, check the fine print. Most ISAs are non-flexible. It's like a one-way ticket. If you withdraw £3,000 and put it back later, that counts as a new £3,000 contribution, eating up your allowance. But with a flexible ISA, you can withdraw and replace the money within the same tax year, without losing any allowance. This is perfect if you sometimes need short-term access to your savings. Always check, is my ISA flexible before you open it? Now, you know how to protect your money using cash for safety and investments for long-term wealth, without letting unnecessary tax quietly eat away at your returns. If I helped you save some tax today or cleared up the confusion, do me a quick favor. Tap like, hit subscribe, and turn on the bell so you never miss the next video. It helps the channel reach more people who want to build a better financial future. Thanks for watching, and I will see you in the next video.